Hi guys, this is Teacher Patty. Welcome to my YouTube channel. So please like, subscribe, share this with anyone who wants to improve and learn from accounting. Okay, so the recognition criteria of assets, liabilities, income, and expenses. Okay, so ladies and gentlemen, in order for an object or a particular transaction to meet a certain element, to meet the definition of a certain element, it must match the criteria completely or almost completely. Ne? So the first thing is the element must meet the definition criteria completely. Ne? Okay, so let's look at that completely or almost completely, guys. I am trying to open, yeah. For example, if you're looking at the definition of an expense, the criteria is it must decrease an asset or increase the liability, and it must be other than that relating to distributions to shareholders. So in order for us to agree that a particular transaction relating to stationery is definitely an expense, there must be a decrease of some sort in the assets, or there must be an increase of some sort in assets. And this must not be related to the distributions to shareholders. So that's why that's the first thing that must happen. Otherwise, if a particular transaction or a particular case study does not meet a certain element, then we're not gonna recognize it. It has already failed the definition test. Okay. So the next thing is if the user finds the information useful, then this must the case study or the question or the question at the end or the element that has been identified prior, whether it's an expense or asset, or then it must meet this second dimension. Remember, the first dimension is the element's definition must be met. So now the second dimension is relevant and faithful representation. Okay. So what do we mean? So what do we do if an element meets the definition of the criteria? So if we agree now that the element meets the definition of a criteria like the expenses, né? So we record a journal entry. Let's assume here yes. So let's assume here it's the stationery. It's the stationery that is decreasing the asset. Let's say it was stationery purchased cash. Then it means the journal entry we're going to recognize the expense after it has passed, that indeed it is an expense, and then recognize a credit as bank, and then determine if we seeing it as an asset according to the definition of an asset. Okay, so the journal entry will be debit stationery maybe with 100 Rand, credit stationery with 100 Rand. Okay, then once you've recorded, remember now, this is when the element is meeting the definition. You will record now. It is meeting the definition and the recognition criteria. You'll record a journal entry because that is how in real life and also theoretical life of accounting, that's how transactions are recorded. Then you record the elements or the element in the financial statements. Ne? So if you agree that this is an expense, if you're agreeing that this is an expense, obviously you'll put it in the statement of profit or loss and other comprehensive income. If you're agreeing that this maybe is an asset, you'll present it or disclose it in the statement of financial position. So what if the element does not meet the definition criteria? Then you disclose that on the, you don't write it on the financial statements. I emphasize again, you don't write it on the financial statements. What do? You disclose this in the financial statement notes. So you make a disclosure in the financial statement notes. You do not make a general entry, you do not record the amount in the financial statement because it does not meet the definition. Okay. So in fact, what does relevant mean then when you're saying the criteria must meet relevance and it must meet faithful representation? So you always, it always, okay, some of the material that's out there on accounting says there must be cost over benefit in terms of information. Information must be very useful, equal to the money you paid for it, or even way less. Okay, so once it's the vice versa, then it doesn't make sense. So, okay, so relevant when you benchmark against the two. The existence uncertainty. So these must be at an acceptable level. Do we really have the element or not? Like, do we really have the asset or not? Or do we even have the right, better yet? Okay. Okay, so outcome uncertainty. Can we determine if there is going to be a transfer of cash or non-transfer of cash? Okay. Faithful representation is based on one aspect only, and it's measurement uncertainty. Can the amount be measured, observed, estimated within an acceptable level of uncertainty? So guys, I hope you remember this, because remember, in answering the theoretical framework question, you're first going to put the model definition for each element that you think they are questioning, and then you're going to do the recognition criteria. Then apologies about that. Then you do the recognition criteria. Then you write, you do the application, that you write the conclusion, and now you disclose on the financial statements. Thank you so much, guys. Oh man, I'm so sorry. I'm so sorry. I'm so sorry. Yeah, the unnecessary pressure, the deadlines, the competition, I know it. The sabotaging, the unfairness, the ruthlessness, but we trust God. It's a phase you have to go through. As much as it's painful, as much as it's like, yeah, it's a phase you have to go through. The moment you finish those articles, you'll have a clear mind of where do you want to go. Just don't quit. Don't quit. Play the game. Trust God. Pray unto God. Cry unto God. Don't cry before everyone. Act very strong before everyone, and always be on. Always watch around you, and always be the leader mentally. Sorry, when you go home, that's me burping there. When you go home, then you cry unto God. Call a psychologist. Call your psychologist. Or call the South African Depression Line or what. And you might think, no, it's still small. It's just that they didn't understand when I was not meeting a deadline. Call a psychologist. They must help you process the pain. Because what the mistake we do or incorporate is a mistake we do when